So on that note, Giordi, I'm going to pass it over to you and Boo. I'm not sure who's going to be presenting, but I'll turn it over to one of you to take it from here.
All right, thanks, Terry. I guess I'll take the mic, Boo, if that's all right.
Sure.
Thanks everybody for joining. Really appreciate the time, and I'm really happy to share with you what Arch is up to, what we're all about, and really give you some insights into where we play in the Canadian real estate market. And Terry's done a lot of the hard work for me. I think he gave a pretty succinct overview of what we're all about. But essentially, we started Arch to address what we see as a pretty big imbalance right now in the Canadian housing market. And this is stuff that's going to be very familiar to this group. So not news here, but I think worth highlighting. And the main pieces we think about are where home prices are these days. So prices have obviously gotten high in recent years. The market's been appreciating quickly and far ahead of average Canadian wages. So we have this imbalance and disconnect between what people are making and where house prices are. And of course, with that pricing level, the down payment requirements by virtue of the legislation in place have also now started to exceed buyer savings. And we're in a bit of this vicious cycle where, on the plus side, houses are appreciating, which is good for those that own, but it's tough for those getting into the market. And so it's a real issue. And a lot of smart people are thinking about this problem, but there haven't been real solutions to it yet in our eyes. And of course, everybody, recently, touching this market was affected in some way by the introduction of new mortgage rules. And in many ways, those, I think came from a place of good intention, but obviously the effect was a reduction in buyer power, a reduction in turnover for a lot of the market. So again, broad-reaching effects of that. And so ultimately, our big take, and the stat that always sort of blows our minds, is this stat that came out in 2018 was that 1 in 4 renters had less than 5K. So if you have $5,000 in the account, what is your path to actually accessing home ownership? Be it a condo, be it a single-family home in Canada. I mean, it's pretty slim. So this is where Arch came in, and we were designed to basically address these gaps. And the mechanism to do that was by offering interest-free down payments. And so this is really filling in for that down payment requirement, so working within the existing system, but recognizing that adding more debt, at least in the traditional sense, doesn't get us there. So these are interest-free down payments. So the program we're talking about today is a program called Arch Foundations. And again, we provide interest-free down payments as an advance to the buyer. And these are interest-free, they're not considered debt. And the reason being is that we take our repayment and the appreciation out of the equity in the home. So we basically made a bet on that home that it's going to rise over time. It's been a safe bet in recent years, but something we definitely believe in Canada in the long term. And that really is where our return comes from. So again, the key point to this, and we'll go into some of the legal if anybody's interested, but we aren't treated as a debt instrument. We're treated as equity, which means we don't affect things like mortgage and loan to value and all that stuff. So this program, it's new to Canada. It's been used in relatively rare instances, sometimes within developments. You will see developers maybe offer down payment returns and things like, but generally it hasn't been adopted in the market. The banks aren't able to do this by virtue of the legislation. So it's pretty new to Canada. We've seen it in the US a bit. We've seen it in Europe. It has really taken off in Europe and is gaining a lot of traction in the US. So we came in looking at what's worked in those different economies and have really come up with a model that we think works well for Canada and the Canadian consumer. So our target audience is really those who are in sort of the prime, near prime area. And we'll kind of get into why that decision is, but ultimately there's a lot of demand within that community. I highlighted that really this is all about that struggle to accumulate enough savings to pay for a down payment. Well, often those people can be, well paid, have stable cash flow, predictable cash flow. But again, it is a task, if you're buying in rapidly appreciating markets, to really accumulate enough wealth to get in by putting down an appropriate down payment. So where this obviously makes a lot of sense is within the first-time home buyer market, because they haven't had a chance to gain wealth by virtue of owning a previous asset. This is a really, really troublesome time period for those folks. And certainly a market we're interested in targeting. I mentioned the U.S. and the U.K. because the iterations of these programs that were deployed down there were typically focused on subprime, near prime, bit of a different market, bit of a different approach to real estate. What we found here is that prime and near prime buyers, obviously the risk on stability, cash flow, approval by mortgage lenders is is not so much of an issue, and the demand seems to be extremely high. And we'll dive into that. So this is the just the gist of the model. Really, really simple version of how this works in practice. So we will provide up to 20% of the purchase price of a home. So really fulfilling that down payment requirement by regulation. So in this example, so $500,000 house. Let's say we buy a house in Hamilton, $400,000 mortgage. We'll put down that $100,000 down payment. And again, that's not done as a piece of debt. That's done as an equity contribution into the house. And that's confirmed with the regulatory frameworks, the powers that be, as well as many of the lenders we work with. So, we will not charge interest on that. That money is out the door. But when we get paid is when the asset sells. And the metric by which we realize our return is that we'll get 2.5 times our down payment percentage appreciation. So what that means is if we put in 20% off the bat to facilitate the home purchase, we get up to 50% of the appreciation when they sell. And so in this simple example, if that house sells at $600,000, let's say 5 years later, part of the appreciation obviously goes to the homeowner, but our principal is returned to us along with that percentage appreciation, which in this instance would be 50K. So ultimately that comes down to us getting 2.5% on appreciation for every 1% that we invest. And this is, as I said, it's a shared equity program, so it isn't a co-lending or debt piece. So that means we share the risk. So in the case of a downturn or a sale at a loss, we would eat some of that loss. And I think it's something that obviously within an appreciating market where there's relatively low rates of foreclosure, but certainly low instances of significantly below purchase price sales. This is a minor risk, but it's something we're very, very cognizant of, and have some interesting mechanisms within the model that I can dive into if anyone's interested. So that's why we do it, because there's we're making long-term bets within the Canadian market, and belief that homes will appreciate over time. But one of the reasons we got started with this, as I said, was to fix what we see as a really intractable issue within Canadian housing for first-time buyers, but also for repeat buyers as prices continue to rise. So there's a lot of reasons why we see this built with the customer in mind, rather than the investor. So that first piece, that it is shared equity, shared risk. Obviously, there's benefits to that in a fluctuating market. We do share that risk with the individual. One of the big pieces I think a lot of people have learned since 2014 is the value of getting into the market at a point that allows you to take part in that appreciation. So getting into the market earlier rather than later can have a real effect on your long-term wealth accumulation. And that obviously relays into the ability, and many Canadians rely on real estate to grow their net worth. But that comes a very significant point. And I think one of the pieces our lending partners and the banks are most excited about with this is because we are considered an equity contribution, not a debt piece, we do significantly expand the buying power of your average customer. For all things being equal, their cash flow, their existing debt, everything else, by virtue of the fact that we bring in 20% without adding additional debt, that does increase the purchase price that people can afford under current lending practices. And so there's some pretty hard numbers behind why someone might do this. We designed foundations basically to displace insurance coming from CMHC. And I say that with our cards on the table, that we had a lot of close conversations and work with CMHC regularly. And so they know that our perspective was, there's an opportunity to save people on mortgage insurance, and that, depending on certain scenarios, can be hugely advantageous in terms of a net benefit to the customer. And so in the example I've given here, back to our $500,000 house with a mortgage rate of about 3% for a typical 25-year term, this can equate to about $30,000 in savings over time on the mortgage insurance side. We also lower payments again by virtue of the fact that we reduce debt load, so that mortgage can go down, assuming your house price isn't increasing, you're not taking advantage of increased purchase power. And ultimately, savings on interest again, because that mortgage is lowered. So there's a real economic argument to be made for using these programs. And we looked at percentage of appreciation, what our markup would be, how we seek return on investment. These were critical pieces for us. So our ultimate test was, can we be better than CMHC? And that, you may argue, that's a low bar to hit for some in certain instances, but for us it was really important, and it's something we continue to build into our models to make sure that we aren't just a product that is an alternative. It's an alternative that is preferred. So in terms of the clients we're after and the ones we work with in this program, again, I think by virtue of the fact that we're in demand, we like prime and near prime buyers. Why would we not? But of course, we're looking to expand to really cover a broad range of the market, from first-time buyers all the way to second-time, to property investors, etc. But ultimately, the individual to us isn't, the part of the risk equation we have to think about. Ours, of course, because we're basing our investment on long-term appreciation. It's all about the strength of the asset. So of course we do diligence on individuals. We think very carefully about what the risk and stability of that individual is going to be, the profile they have for helping a house appreciate. But ultimately, what we're interested in is the strength of that asset. So we focus very carefully on where we buy, what we're buying, and paying attention to some of the macroeconomics in those regions. So why we do this, again, I mean, this isn't meant to be philanthropic or entirely altruistic. The programs we've seen doing this, where they failed is they've tried to be not-for-profit oriented, meaning they can't scale and they can't stay stable. So they always need infusions of new cash. Our perspective was you need to generate something that can operate at scale to make a real dent in the market, which is of course on the order of billions of dollars within Canada. And so it needs to have a compelling investment prerogative, be it for private investors or for public markets. So we've designed our program, the percentage appreciation sort of ratios I showed you earlier. If you back test that over the last 20 years, you're looking about an average rate of return of 15% per year, more than 15% in most Canadian markets. So comparing that to other options over the same period, mortgages on average about 5 and a bit. All real estate combined, looking at the major REITs, was 8.7, and looking at the residential REITs was 12.35. So what we're really excited about is the fact that obviously these returns are significant, but we're not making that sophisticated a bet, right? The bet is that appreciation will happen in the housing market. It is a finite asset, and we've seen real estate grow over time. So obviously, as an entity that's making long term, we have to be okay with changes in risk and volatility, et cetera. But we've designed the company, designed the model to embrace exactly that. And when we say 15%, we calculate at sort of outlandish foreclosure rates. Our rule is to always operate as if the 2008 crisis is happening in Canada every day, all the time. And it's a comfort thing so that we sleep at night to know that foreclosure rates could one day be 8 to 10%, and we have to be built to accommodate that. So, I mean, as Terry mentioned, one of the things we're in the midst of right now is completing the raise of a fund that's under a GPLP structure. We're really excited about that is looking to do is really to be a vehicle to help us expand. And the target of that fund is to distribute between 5 to 7% annually. Our current terms have a 6% guarantee in there, with a target return over the course of the investment of 10 to 15%. Again, we're pretty middle of the road on these projections. If we looked at obviously what's going on right now, the market's extremely hot. We've seen sort of just unbelievable appreciation in certain markets. In Hamilton, the model's done about 22, a little close to 23 in 2020. So really good time, obviously, to be in a situation where you're betting on appreciation. And the way this fund and others we're building are designed is really to turn that over to the investor. Obviously, we have a really interested stake in the appreciation. It drives our overall growth. But ultimately, this is is designed as a fund where most of these proceeds are headed back to the investor. And the reason being is that we came to this market obviously to introduce this model and to fix this issue. But we obviously see a lot of opportunity for revenue generation in verticals attached to fixing this problem. So to give an example, we have, there is obviously an origination fee, a processing fee that goes with this. That includes much of the underwriting as well as checks and balances on the asset. We've also established quite a few different referral relationships with brokers, agents, legal. That really just adds a margin to this deal without any considerations of appreciation. And of course, we derive our revenue based on fund management. So a typical sort of private equity hedge fund type take, 2 and 20%. And again, why would we do this? Why would we, look at sending returns and not betting entirely on the appreciation and do it internally? I mean, it's because the numbers work, and this is the reason why we're excited that this is something that's going to stay rather than be a sort of fly-by-night altruistic attempt to fix the Canadian real estate market. Returns look really, really good. So the lifetime value for our clients in the areas we're working, targeting those prime clients, is about 30K, very close to 30K on an average term of 6 years. One of the reasons we like first-time home buyers, I'll note, is because they typically have a faster turnover. One of the challenges with these models, it's not if you can last the long term and take that long-term bet, the market has traditionally, rewarded you, right? You've been able to track up and the trends are in our favor. But of course, liquidity becomes the big issue. So one of the things we love about first-time buyers is, on average, they're about two years quicker in flipping a property. And so it's something, obviously, we're very interested in making sure we have more liquidity by having those right buyers. But of course, we cover a broad spectrum of folks. And as I mentioned, we are looking now of delving into the world of property investors as well. It's not something that we see as running contrary to this model at all, but obviously has interesting ramifications given the rate of turnover amongst those folks. But ultimately, what the number that we like, our margin, we're looking at making $37 for every $100 invested in these funds. So really, really great margin for a financial product that we think is doing a lot of good. From a demand perspective, again, I probably don't have to tell anybody in this room, what this looks like in Canada right now. But I think we're really excited about some of the macroeconomics that are happening. Just this enormous number of millennials that are really keen to get in the first time, buy their first home, get into the market. And unless they're borrowing, money from the bank and mom and dad, or have accumulated their wealth, this issue of getting it at the right time and getting it early enough is going to get worse and worse and worse. And so we know that, this is going to be a very big balloon coming through the market that's going to need assistance. And we just haven't seen solutions from traditional debt instruments to do it and solve it. So by way of example, and I mentioned for these things to be scalable and sustainable, we'd like to see these funds in the order of $1 billion plus. And within the 5 markets that we target, just in Southern Ontario right now, you're talking about $55 billion in down payments over the next 5 years. So when I say there's a lot of demand, I mean that to do these models in a way that absolutely dominates the market is very, very tough. And we work with some of the big banks on this exact point. Everybody sort of sees the value and sees how this can play a role. But the big question is, what does scale look like in Canada? Because these are very big numbers, and even the monoline lenders and banks themselves, understand that these are significant programs if they're ever going to hit full scale. One of the areas we're really, really excited about is single family homes. I think when we got Arch started about a year ago, there was people that looked at us and said, "Go condo, always focus condo. That's where the growth is." And we've been interested in single family homes because of some of the trends we've seen in the U.S. So one, pricing and availability, huge problems there as well. But there's been a move by a lot of the smart money in the REIT world towards REITs that are based on rental of single family homes, because the demand is just so strong. We've seen a renewed interest in having space. Obviously, COVID-19 gave us a bit of validation on that. There's been a surge in interest in having a single family home. Still significant demand for condos, obviously, and I think that's a market that'll continue, despite recent trends. But I think there's new excitement in this idea that single-family homes are going to continue to be of demand within the upcoming millennial market. The need for us is really obvious. We haven't seen a solution to this problem of down payments, really. And the regulatory, as you guys will all know, in Canada, it moves at a crawl, and even when there are leaps and bounds, we're dealing with a pretty archaic system. So we see a real opportunity to have a long-lasting effect in working with that regulatory framework, but in disrupting it in a significant way. And lastly, single-family homes in particular, I think one of the opportunities we're seeing is there's this just massive amount of equity and assets locked up in the homes of so-called boomers right now. And I think my parents would be remiss to be called boomers in this instance. But I speak personally, watching the turnover of equity and wealth that's about to happen. There will be a lot of these single-family homes coming onto the market, and a significant amount of demand. And this is, excluding obviously the world of new builds and everything else. So we see this as a really, really strong market. The economics on single-family homes are exciting, but as I mentioned, we do certainly play in the condo market and have a couple projects ongoing that are really exciting in that space. I mentioned, we are a company that's focused on the asset ultimately, and so just at the top here, you'll see some of the markets that we really like right now. Coming out of 2019 and moving into this unusual year, just a lot of things that really drive our sort of our respect for the appreciation in these areas. So things like population growth, strong rental demand. We're considering pieces like the time of houses on markets, etc. But in looking at the 5-year CAGR in a lot of these areas, this works really nicely within that model of that 2.5% appreciation. So lots of opportunity for upside based on the Arch model. So that's the product in a nutshell. I know it's a lot, but we try to get through this. So there's lots of time for questions, and so we can have Terry serenade us hopefully by 8 p.m. tonight. But I did want to just share who the team is, because I think Arch is very much a product of a lot of smart people thinking and working hard. So there's myself, and I've come from I was actually a scientist, drug discovery researcher for years, that then worked in venture capital in biotech, then venture capital in fintech, and then now venture capital in property technology. With me, I also have Boo on the phone, who's a broker himself and has been drawn to this model, I think, in recognition of the same things that excite me about it, right? This idea to fix the market, while also coming up with a great way to deliver return. So it's a team really comprised of folks from the real estate space as well as from the startup space. One of the things we're very pleased with is our advisory team. This is just a few of them. It's a big group, but certainly some rock stars. John Orr was the former CEO of President's Choice Financial, was an executive vice president at CIBC, and ran First Caribbean Bank for a number of years. Was one of the first through the door to help us and really saw opportunity with what we were building. And Chris White, who ran lending, he was the senior vice president at D&H. So very tapped in, obviously, to the lending market, and also ran mortgages at CIBC for a number of years. We've added to that many folks in the private equity space as well as the venture space. That really, we think, just brings a great team to the table. And lastly, all sorts of great partners. I mean, a company's only as strong as those they work with. In terms of the primary lenders, we do work with CIBC. CIBC was very critical to us in navigating the regulatory market. They played ball from right from the get-go with helping us get this set up and facilitating some of these big conversations with the right people. So they are a primary lender for sure, but we do work with all the big five. And we also work with many different brokers and various types of lenders, be they private, be they monoline. So just Newborough, as an example, one based in Toronto, we're excited to be working with. Really bent on our legal partners. Fasken Martineau has been fantastic, and one of our technology providers who's built our origination system as well. For those that work with the product and the clients in the future, you get to know it. But a product called Future Vault, they've built a really nice technology piece for us. So with that, I'll hand it over back to you, Terry. I'm happy to answer any questions about the model, or the team, or what we're up to.
Did you say I had to serenade people?
That's what I said. 7:30. Yeah, it's the mark.
Could you take down that guitar then, boy? Let's go.
Just for show.
Just to keep
Making
everybody.
into Newfie tunes. Nice.
That's right. I can, Jeff, we'll get into line dancing here, or step dancing, whichever it is that you also like to do. We'll ask anybody who we'll open it up now for questions, comments, concerns, anything like that. If you want to come off mic, I'll open up the floor to whoever.
I'll have a few, but I don't want to jump in first. Somebody else can go.
All right, I'll go first, Mike.